Hi, everyone. Welcome to the Patty Brennan Show. Whether you have $20, $20 million, or $200 million, this show is for those of you who want to protect, grow, and use your assets to live your very best lives. Joining me today is Eric Fuhrman, our Chief Planning Officer. We're going to be talking today and answering the questions that we have been getting over the last few weeks on the new tax law, the One Big Beautiful Bill Act. What has changed? What is the same? How are we going to be affected? And I want you all to know that Eric actually did a deep dive. He actually read the bill. What goes with that? Who reads these bills, Eric? Right?
Yeah, I don't know. I guess a bit of curiosity. But, actually, it's not the entire bill. So for anybody out there, all of this stuff exists in the public domain. So, for example, if you go to congress.gov, you can look up the One Big Beautiful Bill or any other bill that might be introduced or working its way through the legislative process. But, to me, it's just very interesting. It's a way to, really get into the details of what is in all of this legislation that has broad implications, not just for individuals and let's say what we might recommend to our clients, but also broadly across producers and businesses all throughout the economy.
It's interesting. You were talking about the different sections and how the legislative process works and how each section is really siloed when we think about how this whole thing called the U.S. government is run. Now, we're going to be focusing on Section 7 today, right?
Yeah, so if you look at like the One Big Beautiful Bill, it's actually arranged by titles, and I believe there's 10 titles that they have. But essentially each title is a committee that exists in Congress. So if you get elected to Congress, eventually you may—
No, thank you.
Right, I'm with you. But you'll eventually serve on one of these committees, and these committees are tasked with doing work and designing laws and so forth that ultimately ends up in these bills. So, for example, if you look at Title I, that is the Committee on Agricultural, Nutrition, Forestry. Title II is the Armed Services Committee.
And so basically, if I hear you right, they are making decisions on how to allocate the resources that have been allocated to them. And they're asking for more. They're saying, hey, we're good, et cetera, and how they're going to be using those resources.
Yeah, so precisely. So based on the work that is done by each one of these committees, and I assume they have access, obviously, to lots of data and information, expert witnesses and other people that come in and provide guidance. But ultimately, you're right. They're drafting laws that are just meant to kind of divvy up the pie. How do you apportion funds for certain objectives or entities, and the government, and also write rules and regulations that incentivize certain behaviors, punish others, things like that.
Well, we were talking about this before coming live, and we were talking about the tax law in particular, and how the tax law actually creates incentives for Americans to do certain things. For example, there's a tax deduction for charitable contributions so that, the U.S. government is not the only entity that's providing social services. So if we contribute to a named charity that we believe in, we get a tax deduction for that. That's an incentive. I was given an incentive when I started Key Financial, and Eric, you and I worked together in my basement, which, frankly—
I remember those days.
Yeah. And I'm going to show you pictures. This is us in the basement.
Oh, goodness.
It was unbelievable. At one point, we had 9 people coming in your shorts, raiding my refrigerator on the way down to the basement.
Yeah,
right?
yeah, I remember the food bill must have been outrageous back then.
It was. And I did not take any deductions for the food that you ate, Eric. But I did deduct a portion of the home that represented the square footage, and that allowed my taxes to be lower, gave us more cash flow so that I could hire more people. Right. Here we are at 33 W-2 employees, and we've grown significantly because of the incentives that I was given as the owner of Key Financial and continue to receive. So that's the thing that's the takeaway. Now, it's, taxes are really there to provide a social net. Right? And I thought it was also interesting. What was that guy's name in the 20s?
Andrew Mellon.
Andrew Mellon.
Secretary of the Treasury. Yeah.
Secretary of the Treasury. Basically, he said something to the effect of a nation is not in danger of disaster or a financial crisis if it owes the money to itself. And essentially, the government debt is owned by Americans, so we owe it to ourselves. And I think it's also interesting to point out that with tax policy and the taxes, it is, we talk about government spending, and you can talk a little bit about the charts that you pulled up with Fred, but, it's not all spending. It's also investment, okay? When they allocate these resources, they are investing in infrastructure, for example, roads, bridges, railroads. You guys get to come to work because there are roads to get here. So that's important to differentiate between, ridiculous spending and actual investment that increases our GDP.
Yeah, and I think that's an important point, and maybe it is a failure of the nomenclature in which they talk about spending, but it just tends to be viewed if the government spends money, it's an expense.
It's
but
bad.
Within there are a lot of investments, for example, that are made. So not all spending is bad spending if it is an investment in something that will provide a future return or benefit to society. So think about the national highway system that was invested in when I think Eisenhower was in office. So those types of investments derive a return that society gets. So it's all spending isn't bad spending, but certainly there is
Sure.
the potential and the likelihood of a lot of spending that might be wasteful. And so forth. That obviously is problematic. That's obviously not good spending if you're accumulating debt, and it's not into things that can provide some kind of future return or future, benefit and so forth. But they don't cleanly separate those things out in the data.
And they can even reframe things and use rhetoric to say this is going to be really good for Americans, type of thing. Folks, those of you who are watching and listening, I promise you we're going to get into the tax law and talk about how you may or may not be affected by it. I just want to talk with you, Eric, about one additional thing as it relates to tax and legislation and tax rates over time, and how, they've tinkered with the laws a lot since 1950. But when you really look at the numbers, the revenue that is produced is within 2% or so of GDP. It has always been between 15% and 17% of GDP, the total revenue that's generated. Even though tax rates in the 50s the top rate was 80 to 90%, our top rate has been 30 to 40% in the last decade. And yet the amount of revenue is still about 17% of GDP.
Yeah, so I think that's an interesting observation. We've had, if you just go back to, I think, take 1950, so we're in the post World War II era. There have been many, many major pieces of tax legislation that have changed tax laws, changed deductions. I mean, if you go back into the 70s, we had, far more tax brackets than exist today. But there's been nothing but constant change in the rules. But to your point, if you think about the size of government, and you could measure that basically as the amount of tax revenue as a percentage of GDP as output, that would be, I guess, one way to measure the size of government. Despite all those changes, all these major pieces of legislation, you're right. The tax revenue is always about 15 to 17.5% of output. Regardless of all this change, government always seems to represent kind of a constant percentage. And sometimes it deviates outside of those ranges, but it's always very consistent despite these very bold and dramatic bills. Ultimately, what is it really changing? In the grand scheme of things, it doesn't really change the footprint of government all that much.
Although, for people who look at the raw numbers, look at the size of government, right? Look at the amount of debt we have.
Yeah.
But let's be honest. I mean, our GDP has risen since 1950 from $2.2 trillion to almost $24 trillion. That's 10 times in terms of growth. So it feels like it's a ton that our government has gotten so big, because it has, because the size of our government has increased tenfold just using that constant of 15 to 17% of GDP.
Right, along with the economy. But people are far better off today. Again,
100%.
on average,
Yep.
people are far better off today as a
Quality
country
of life.
than certainly they were in the 1950s.
Yep.
And even when you go back to Andrew Mellon,
Yeah.
okay, so he was Treasury Secretary, I guess, back in the 20s and early 30s. But you can read speeches by him, and even then in the 20s, he talks about how America at that point in time, and that's well before the 1950s, was one of the most prosperous nations on earth
The Roaring
in terms
20s,
of
yeah.
how people are doing and how citizens are living. So this has been a very kind of durable trend that has persisted. If you kind of go back and look
It's
at
interesting.
things through the lens of history.
What you said before we went live is that if you read that speech could be given today.
Oh, yeah, it's amazing. If you
Yeah.
go back and read some of the speeches from then, there's so many elements that just are applicable today. You'd almost think a politician today was giving it. But, I think let's, why don't we turn our attention to the bill?
Yes. Let's do that.
And again, unfortunately, it's a big bill, as the name says, so we're not going to be able to go through them. So I think what's kind of germane to our conversation today is the discussion around Title VII, which is the Finance Committee's work here. And this is where they really get into things that affect, our clients and listeners out there in terms of individual tax rates, deductions, for anyone out there who's an entrepreneur and a business owner, affecting, obviously the opportunities to depreciate, deduct, and other things like that. So, what I found interesting kind of diving into that on congress.gov is that, there are elements of this that are permanent.
Right.
And I think for those of us that operate in this financial ecosystem, if you're an advisor or a CPA, maybe a estate planning attorney, there's an element of this that is good because it's created some certainty in terms of help advising people and giving them the advice where that advice is going to be sound as we move forward into the future. But the other interesting part is there's a lot of elements that are in there, but they're temporary. These are not permanent things, and these more seem to fall along the lines of the campaign promises.
Exactly.
To deliver on them, but they're not necessarily permanent elements, so they'll be here for a period of time, but they may not be here in the future because they're not extended or they expire.
And this is where I think it's really important that we caution people, right, to really understand the landmines that are out there, especially with these temporary changes. Some apply in 2025, some don't start until 2026. Some go until 2028. There's a couple that go to 2030. So, there's a number of things to pay attention to. Always seek advice from your tax advisor, your CPA. We are never going to be able to replace those relationships. They are the experts. We're just here to give you the high-level stuff to pay attention to.
Yeah, so I guess my thought is maybe for listeners out there, maybe we can start off by highlighting some of the things that are permanent, where at least we have some clarity there and certainly affects the kind of the everyday, person.
Perfect. So I can list them for you. Ready?
Okay, great.
Folks, get a pencil, write these down. Tax rates stayed the same. The estate tax rates starting in 2026 have become permanent. So each individual has a permanent exemption of $15 million. And what that means is a couple has $30 million that they can leave to the next generation or anyone, and there will be no federal estate tax. The excess over that amount would be taxed at 40%. The standard deductions have become permanent, and there is a perk, a temporary perk for those people listening or that you're advising who are 65 years and older. There is a new additional standard deduction of $6,000 per person. So it was kind of...
And this is the one that I think was let's say, marketed
Yes.
as for seniors, so they wouldn't pay any taxes on
the
Social Security.
Right. Yeah.
I guess that's the way it's presented, but it doesn't actually operate that way when you kind of work your way through the 1040, meaning
Exactly.
the tax, individual
Exactly.
tax return.
Yeah. So be careful with that one.
Yeah.
It's terrific. Okay. And many people are going to benefit from it, but it doesn't necessarily mean that your Social Security is not going to be taxable. The miscellaneous itemized deductions, permanently gone.
Mm-hmm.
However, for those of you who are teachers and educators, there is a new non-miscellaneous deduction for expenses that you pay for your kids, for educating the people that you are teaching. And that is brand new, and that is also permanent.
So what about, I feel like one of the big ones there that's hanging out there is this whole modification of the SALT cap.
Yes.
Because I feel like this is something that catches so many of our clients and many people. You don't necessarily have to be a high income earner, where they limited the deduction for, let's say, state and local taxes to $10,000 and it was capped. So that really impacted people that, say, have high property taxes, or people that were high income or just happen to live in states where there's a very high state income tax rate, like, let's say, New York or California, for example.
Yeah, those
they have
states
very
were
high
really
rates.
pushing for this increase.
Yeah, so we're in Pennsylvania, it's 3%, so it's not zero, but but
Sure.
it impacts. But that modification, I guess, that's going to be big for people, where for the last 8 or 9 years, most people are just taking the standard deduction. But now the ability to go back to this itemization, the door for that might be open. So
it could
how's
be
that work?
very interesting to see the impact on our clients, because they increased that amount from $10,000 to $40,000. Of course, there are income limitations. So if you have an income that is below $500,000, you get the $40,000 SALT deduction. You can go up to $40,000. Between $500,000 and $600,000, it begins to phase out. If the modified adjusted gross income is over $600,000, you're back to square one with a $10,000 cap. So again, there's always caveats and stuff like that, but it could be really beneficial for many people.
Yeah, and I guess the key thing there too is that with the change in the SALT deduction, that then means that people may be able to start deducting mortgage interest.
Oh, 100%.
So like to your earlier point about what is government policy doing, it's incentivizing certain behavior.
Right.
So here, deducting mortgage interest is incentivizing home ownership.
Right.
But a lot of people couldn't take advantage of it.
Exactly, because they were just taking the standard deduction anyway, so they weren't deducting it. There is a new twist on that, Eric, and that is for people who are paying mortgage insurance premiums. I think starting in 2026, I could be wrong on that, that's going to be bundled into the mortgage interest deduction again.
Oh, gotcha.
People used to be able to write it off, and then they got rid of it in 2017.
Yep.
It's now back in. So again, if you're paying mortgage insurance on your mortgage premiums, you can deduct them again.
And what's interesting there, I mean, this is just speculative on my part here, but when you think about the incredible kind of prodigious increase in the cost of housing, you have to wonder if a lot more people that have purchased a home are paying mortgage insurance because they couldn't meet that 20% down payment. So so maybe that will provide some extra relief for new homeowners.
Yes, exactly.
Yeah.
We were talking about Elon Musk and the amount that he contributed to the campaign, et cetera, and it was interesting that within this bill, most of the clean energy credits are gone. Okay. However, you brought up this new space bond that is out there now. So if you invest in a bond that is investing in space in some capacity, the interest you receive on it will be tax free.
Yeah, so that's kind of a new development, I guess, in the market for tax exempt securities. So now we might start seeing space bonds issued, and essentially these are no different than a bond that might finance the construction of, let's say, a highway or a hospital or something like this. But these would be bonds issued to finance the construction of infrastructure for space, activities, and essentially those bonds are tax exempt from federal taxes. So I have not seen one yet, but who knows? 5-10 years into the future,
Sure.
They might be more commonplace.
And it'll be interesting to see the maturity on these bonds. Are they going to be 30-year bonds?
Yeah.
What is our world going to look like in 30 years, especially up there in space, right? Think about what we've done in the last 30 years.
Yeah, absolutely. So, and I think you're right too. The other elements here, if you look at some of these other, sections of the bill, certainly, tax credits that had been historically provided for clean vehicles and other, energy efficient improvements, all things where the tax code had provided, deductions and credits. A lot of those things are going to be scaled back or stripped out, anywhere between October of this year and early next year.
Right.
So if you are contemplating the purchase of some of these things where there's a credit, there might be an incentive here to
and some of the credits are kind of juicy. I mean, the solar credits and things of that nature. So, again, we're not encouraging people to spend their money too much, but if it's something, to your point, if they're thinking about it already. So let's continue with some of the temporary stuff. Mm-hmm. There's no tax on tips. Mm-hmm. It's basically a deduction. And overtime, right?
Right. So, and I think the tax on tips, that's an interesting one because I think it's, as long as it's qualified tip income. So for anybody that's working in the service business where you're receiving cash and not reporting it, things like that, but it's got to be qualified income that's kind of run through your W-2. And I think the limit there is $25,000.
Right.
So up to 25, you can exempt.
Yep.
Yeah.
And I think you've brought up a good point with that one, as well as all of the others. There are tax torpedoes in this new legislation. We've always had to deal with unintended consequences when we're making recommendations. And we find sometimes, with Roth conversions and the 12% tax bracket, those are two areas that we really like to look at towards the end of the year to really see if clients can take advantage of them. But again, there are some landmines with those things. Somebody might find themselves, that would, be in a 12% tax bracket, taking capital gains and having to pay 15% on it. Mm-hmm. That doesn't make sense, right?
Yeah, I think it's interesting too. Even though some of these deductions and limits and things like that have changed, I think the basic principles still apply as if this bill hadn't been passed, which is you just have to be very careful before making these decisions and really running the numbers or having a professional run the numbers, because ultimately, all these things are interconnected.
Yes.
So doing one thing can, diminish the benefit of that transaction somewhere else on your tax return. So I think you always have to continue to be prudent in making any of these, considering any of these opportunities.
You know what, Eric? How about these new Trump accounts that are being established for children that are born, right? And we were talking about the mechanics of it. It's not going to be like a tax deduction per se or a tax credit. They're actually going to, for every child that is born next year or later, they're going to throw $1,000 into an account for that child. And you can also contribute up to $5,000 per year. And of course, that baby's not working. You don't have to have earned income to be able to have these accounts. And at age 18, that child will own the account. So it's a very interesting, I'll be interested to see the actual implementation of that and how it's going to work. But that's a great planning opportunity for many families and their children. So when they're 18, they do a Roth conversion of that account, and it could be sizable depending on how many contributions have been made.
Yeah, again, I guess that's one of these kind of interesting temporary elements that's in here. Something kind of totally brand new, but it's temporary, and I guess we're still trying to get our arms around how it works. But yeah, so my understanding is the same, that within this period of time, this window, the government will contribute $1,000 for any kind of new baby born. that doesn't incentivize. I think for me, the ship has sailed, so we're not going to be having any more kids.
You and me both.
At least at my stage in life.
I don't know that $1,000 is enough of an incentive, knowing the cost of raising a child.
Oh yeah. When you think about daycare, summer camps, all that good stuff. But no, it's an interesting tool, and I think there's the ability to contribute. I think $5,000 a year up until they reach the age of 18. So just kind of a new account, but again, it's not permanent. So I don't know how this will all resolve itself once these things expire and so forth. But, it's interesting when you talk about that and we're thinking about kids. This is kind of a good segue into looking at other elements like 529 plans, for example.
I love this part.
So they've expanded. Normally 529 plans traditionally were a vehicle to save and use for education, like in a university setting and so forth. But then they expanded that to K through 12 education, but the limit there was $10,000 a year, and apparently within this new bill they've expanded that to $20,000 a year.
That's a nice little perk. Right,
yeah, so it just doesn't have to wait until your child matriculates into school at age 18. It can be used if you're using any kind of religious-based or education, private education, thing like that. So
and they did increase the child tax credit to $2,200. From 2000, so that was good for those families out there that are listening. That's the good news. I will say that on the other side, with the itemized deductions, high income earners are going to be kind of hit again. While they permanently repealed and got rid of that old P's limitation for itemized deductions, there's this new very funky calculation. 2 divided by 37, and it's applied to your income, and your itemized deductions get reduced by that amount. It's really funky. So even though you might have a lot of itemized deductions, they might be whittled down a bit. Not by a lot. Again, most of this stuff is just some tweaking. I don't think anybody listening is going to get hit hard by this new tax law or benefit greatly either. But there are some things to be aware of.
Yeah, so I guess leave it to the government. They've made things more complicated.
It is so complicated.
Yeah, but I guess that's interesting too. There was some criticism here, especially on the higher brackets. Those rates are more or less made permanent. But ultimately, the devil's in the details. So a lot of these deductions and other things, may be phased out for people that find themselves on the higher end there. So, they may not derive the benefit of some of these deductions.
Okay, so that's a good segue. Let's kind of summarize this, Eric. Winners and losers.
Yeah, so I think, your concept of winners and losers, again, when you look across the bill, there are certain elements when you look at these committees where they are expanding funding, reducing rules and so forth that make the cost of business going down. So, for example, if you look in like the agricultural sector, expanding funding there, armed services, defense, expanding funding there. If it's Homeland Security or the judiciary, they're expanding funding. So in essence, you might think that those might be the winners in those particular segments. If you think about what we're talking about today, the tax portion, I think in general, it generally benefits, middle to upper income households, just in terms of tax relief, and so forth.
The other thing is the estates. That's a big perk, right? The ability to transfer assets to the next generation without taxes, and having, having an understanding of the rules of the game. The $15 million is permanent and increasing by inflation each year. So you're right. Corporations, high-income estates, people with newborns, families, there's some nice perks in there. And the SALT increase is a nice thing. And tips and overtime. Again, these are temporary. People who do not benefit, or I don't want to call it losers necessarily, but low-income families reliant on Medicaid and SNAP. A lot of those programs have changed. People who are investing in clean energy and those sectors, and communities facing health or food aid cuts. So people are worried about deficits, and our deficits are going to rise. We've talked about that from the beginning, but that's really how it all shakes out. It's mostly tweaks. It's not going to be significant, I think. And again, we're going to be running numbers and talk to your tax advisor and see how it all shakes out on an individual basis. Right?
Yeah, absolutely. And I thought an interesting little part towards the end of the bill is that they did increase the debt limit by $5 trillion. So,
there you go.
So
right.
I would expect, regardless of what you feel about the bill, the reality is they recognize that the debt will continue to increase, and it doesn't seem to be slowing down anytime soon.
Any end in sight, right?
Yeah.
Yes. So thank you, Eric, for joining me today, and thanks to all of you for joining me as well. And I hope you found this helpful. We will have some transcripts on our website. And if you have any questions, as always, go onto our website at keyfinancialinc.com. We're happy to answer any questions you might have. Eric Fuhrman, our Chief Planning Officer, thank you for all the research that you did.
Thanks, Patty. Delayed to be here. Podcast day is always a fun day. I have trouble sleeping the night before. So.
Oh, you and me both. We do a lot of prep work for it, but it's important because we want to get it right. Yep. And there's so many things out there, folks, that are incorrect or leaving out important caveats. So be careful. Thank you for joining us. I'm Patty Brennan. I hope you have a terrific day. Take care.
The following presentation is sponsored by Key Financial Incorporated. The Patty Brennan Show is intended for general information purposes. Only any non-employee guest speaker who joins Patty Brennan on the show is a guest and is not an affiliate of Key Financial. Their remarks do not necessarily reflect Key Financial's opinions or positions. Key Financial neither prepared nor verified any portion of our non-employee guests' presentation content and has relied upon the accuracy thereof. No portion of the presentation serves as the receipt of or a substitute for personalized investment advice from Key Financial or from any other investment professional of your choosing. Neither the information or opinions contained in this or any podcast, white paper, or on Key Financial Inc.'s website constitutes a solicitation for the purchase or sale of any securities and should not be relied upon as financial, legal, or tax advice. Content may be outdated, and past history is no guarantee of future results or experience. Please seek appropriate counsel from qualified professionals who know and understand your goals, objectives, and potential vulnerabilities. Thanks for listening to The Patty Brennan Show, brought to you by Key Financial Inc., wealth management with wisdom and care. Securities offered through Osaic Wealth, Incorporated, member FINRA SIPC. Investment advisory services offered through Key Financial Incorporated. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth. The Barron's Hall of Fame acknowledges advisors who have appeared in Barron's annual Top 100 Advisor rankings for 10+ years. The Hall of Fame honors advisors who exemplify long-term success and commitment to their clients. Rankings and recognition from Barron's are no guarantee of future investment success and do not ensure that a current or prospective client will experience a higher level of performance results. And such rankings should not be construed as an endorsement of the advisor. The Forbes ranking of America's top wealth advisors is based on an algorithm of qualitative and quantitative data, rating thousands of wealth advisors with a minimum of 7 years of experience, and weighing factors like revenue, trends, assets under management, compliance, records, industry experience, and best practices learned through telephone and in-person interviews. There is no fee in exchange for rankings. Forbes Best in-State Wealth Advisors 2023 list, February 2023. The rankings for this list by Shook Research is based on due diligence meetings to evaluate each advisor qualitatively. A major component of a ranking algorithm that includes client retention, industry experience, review of compliance records, firm nominations, and qualitative criteria, including assets under management and revenue generated for their firms. Forbes is a trademark of Forbes Media LLC. All rights reserved. Rankings and recognition from Forbes Shook Research are no guarantee of future investment success and do not ensure that a current or prospective client will experience a higher level of performance results. And such rankings should not be construed as an endorsement of the advisor. The Ernst & Young Entrepreneur of the Year Award recognizes the endeavors of exceptional men and women who create the products and services that keep our worldwide economy moving forward. Third-party rankings and recognition are no guarantee of future investment success and do not ensure that a client or prospective client will experience a higher level of performance or results. These ratings should not be construed as an endorsement of the advisor by any client, nor are they representative of any one client's evaluation. Thanks so much for listening. See you next time.